The mathematics of wealth and markets is the foundation behind how money grows, how investments behave, and how financial systems operate. Although markets may appear chaotic or unpredictable, many of their behaviors can be explained using mathematical principles drawn from probability, statistics, and economics. Understanding these ideas helps explain why wealth accumulates for some people, why markets rise and fall, and why long-term strategies often outperform short-term speculation. One of the most fundamental mathematical concepts in wealth creation is compound growth. Compound growth occurs when returns generate additional returns over time. Instead of growth increasing at a constant rate, it accelerates because each new gain is added to the base that produces future gains. This idea is closely related to the scientific concept of exponential growth. If an investment earns a consistent percentage return, the total value increases faster each year because the growth builds on itself. Over long periods, even modest returns can transform small investments into significant wealth. This is why long-term investing and reinvesting profits are considered powerful financial strategies. Another key mathematical principle in markets is probability and uncertainty. Financial markets are influenced by millions of participants making decisions based on information, expectations, and emotion. Because of this complexity, exact predictions are nearly impossible. Instead, mathematicians and economists use probability to estimate likely outcomes. Tools from statistics allow analysts to model risks, measure volatility, and evaluate how likely certain market movements are. Investors rely on these probabilistic models to determine whether a potential return justifies the risk involved. Risk and volatility are also deeply mathematical concepts. Volatility measures how much the price of an asset fluctuates over time. High volatility means prices change rapidly and unpredictably, while low volatility indicates more stable behavior. Mathematically, volatility is often calculated using standard deviation, a statistical measure that shows how widely values deviate from their average. Understanding volatility helps investors manage risk and design portfolios that balance potential profit with acceptable levels of uncertainty. Diversification is another concept rooted in mathematics. Instead of putting all funds into a single investment, spreading capital across different assets reduces the overall risk. The logic behind diversification comes from probability theory and correlation. If two assets move independently or in opposite directions, losses in one may be offset by gains in another. By combining assets with different behaviors, investors can create a portfolio that produces more stable returns over time. Mathematics also plays a crucial role in pricing financial assets and derivatives. Advanced formulas are used to estimate the fair value of options, futures, and other financial instruments. One of the most famous models in finance is the Black-Scholes equation, which helps determine the theoretical price of options based on variables such as time, volatility, and interest rates. These mathematical models form the backbone of modern financial markets and are widely used by banks, hedge funds, and investment institutions. Game theory also influences market behavior. Markets are not just mathematical systems but also strategic environments where participants react to one another's decisions. Investors try to anticipate how others will act, which can lead to trends, bubbles, and sudden crash. Mathematical models from game theory help explain how competition, cooperation, and information asymmetry shape financial outcomes. Another mathematical idea influencing wealth distribution is the power law. In many economic systems, wealth does not distribute evenly. Instead, a small percentage of individuals control a large portion of total wealth. This pattern, sometimes described by the Pareto principle or the 80-20 rule, appears in many natural and social systems. Mathematics shows that small differences in opportunity, investment returns, or network advantages can compound over time, leading to significant disparities in wealth. Modern financial markets increasingly rely on computational mathematics and algorithms. Quantitative trading firms use complex mathematical models to analyze data, detect patterns, and execute trades automatically. These algorithms can process vast amounts of information much faster than human traders, allowing them to respond to market signals in milliseconds. Despite the sophistication of financial mathematics, markets remain influenced by human psychology. Behavioral economics shows that fear, greed, and cognitive biases often cause people to make irrational financial decisions. This means that while mathematical models can describe patterns and probabilities, they cannot perfectly predict human behavior. Ultimately, the mathematics of wealth and markets reveals an important insight. Financial success is rarely about luck alone. It emerges from understanding growth, managing risk, making informed decisions under uncertainty, and allowing time for mathematical forces like compounding to work. Markets may seem unpredictable in the short term, but over long periods, the underlying mathematics often reveals clear patterns and principles that shape how wealth is created and preserved.